let's talk about Schedule A. All right, you guys want to talk about Schedule A? Fun time. So, Schedule A, so remember, we identified the sources of income. These are some of them, not all of them, but on the 1040 you could see all the sources of income that are reported there. We add those, we get our total income. Then from that, there's a number of adjustments that we could subtract. That's going to reduce our total income. When we subtract those adjustments, what we're left with, right, so we have our total income, all those sources of income, we add them up, that's our total income. We have some adjustments, and then we're left with what's called the adjusted gross income, which we refer to as AGI. AGI. So if you see that on the exam, AGI is adjusted gross income. And then from our adjusted gross income, we put that on the first line of side 2 of the 1040, our adjusted gross income. From the adjusted gross income, we could further reduce our income by either taking a standard deduction or an itemized deduction. The itemized deduction requires us to fill out Schedule A. Then we could also subtract our exemptions. So if we have dependents, so one of the things that we're going to talk about is what does it mean to be a qualifying child? So who could be a dependent? So there's some criteria in the Internal Revenue Code about what does it mean for a person to be your qualifying child or your qualifying relative, and to be basically your dependent so that you could claim them on your return. So we subtract our exemptions, and for 2014 that's $39.50 per exemption. And we're left with our taxable income. So directionally, what we're hoping is going to happen is that our taxable income is going to be as low as possible. So we're hoping to benefit from, obviously, these itemized deductions so that it reduces our adjusted gross income. If our taxable income is less, then the amount of tax that we owe is also going to be less. Does that make sense? So the less the taxable income, the smaller the taxable income, the smaller the amount of the taxable income, the less tax we have to pay. That's a good thing, right? Anybody want to pay less tax? Anybody here want to pay less tax? Raise your hand. All those want to pay less tax, raise your hand. Only Warren Buffett wants to pay more tax, right? Questions about that? So now the standard deduction the amount of the standard deduction is based on your filing status. Say, okay, what's that? All right, so let's talk about the filing status. So a person can be filing, as they could be married.
file separately.
They could file separately, or they could file jointly. So the filing status, you have to pick one. Check one. All right, so only check one. So on the 1040, you'll see there's a box there. So you only check one. Either you're single or you're not. Most people know if they are not single. You could be married, like Zoya said. If you're married, you have the option to file a joint return with your spouse, or you could file separately. And then Zoya also pointed out that you could file as a widow or widower. And one that intrigues a lot of people, especially single people, is head of household. Yep.
Explain that one a little bit.
Okay, so if you're single, but you have a dependent, a qualifying dependent, and we're going to talk about that, what that means to be have a qualifying dependent.
Like if you adopt someone,
Child to a relative.
like you adopt a child.
Oh yeah, well there's a whole list of yeah. Yeah, so we're going to get to that. What are the tests? There's a series of tests. And one of them is the relationship test, right? So that's something that, that needs to be addressed. So the head of household has a higher standard deduction. So before we get into that, let's first close on this point, which is, what is our filing status? And importantly, what is the standard deduction that is allowed for each of these? So we're at the point now in our tax return where we're talking about deductions. Either we're going to take the standard deduction or we're going to itemize our deductions and fill out Schedule A. So for 2014, and every year it changes like by 100 or like $150 or so. Progress, we're making progress. So in 2013, for single, it was $6,100. But in 2014, it's $6,200. So for married, filing jointly is $12,400. Filing separately?
$6,200.
And for qualifying widower?
12,400.
And for head of household?
9,100.
9,100. So last year was 8,950. So if we have deductions, if we're single and our deductions are more than 6,200, so now we're trying to decide whether or not we're going to itemize our deductions or just take the standard deduction. So on the 1040, so on the 1040, look at line 40. Right, so line 40 is where we're going to either put the standard deduction amount or the amount from Schedule A where we itemize our deductions. Everybody see that? So on the front of Schedule A, one of the very first things that you put, which is basically line 1, is what is your filing status? So beneath your name and address, is your filing status. So you have to decide, you have to select which filing status applies to you. And that's important because that's going to determine the amount of your standard deduction. So you see, all these numbers are not the same. So if you're head of household, if you're single with a qualifying dependent, your standard deduction would be $9,100 versus $6,200. That's a pretty big difference. That's almost $3,000. Now we're not talking about, oh, it went up $100 from last year. That's almost $3,000. That's a big difference. So you want to make sure that your filing status is correct because it has implications for your standard deduction. So we select.
Sorry, but that's excluding the being over 65 and by, right? Okay. Because
Yes.
so like in the exam, if you're asking us like what is the standard deduction
Right.
for someone who's single and that's it, then it's 62. But what if you ask for somebody who's single over age 65 and blind, then you have to put an additional.
Right. So go ahead. Tell us more about that. So what Giselle is saying is that the standard deduction amount is different, right? The standard deduction amount is higher if you're over 65.
Right. You want additional.
So this is if you're under 65 and not blind. All right, but everybody's got what Giselle is saying? That's important. We're not focusing on that for this example, but if you're over 65, then the standard deduction amount would be higher.
Okay, one more thing. Additionally, I know that you have to know for each year what the deductions, but what are you going to be focusing on more? Should we focus on current or even the calendar?
All right, so I'll tell you the year.
Okay.
Yes, I'll tell you the year. Any other questions?
Sorry, is there a specific, not specific, is there any scenario where you would have more than 6,200 if you're single in deductions, but it would still be a wiser choice to take the standard deduction over itemizing?
Well, I can't think of any at the moment. I mean, if you fill out Schedule A and your itemized deductions are 18,000, I don't see why you wouldn't itemize the deductions. But keep in mind that this is a freebie, so to speak. You don't have to prove the 6,200. So if you're single and you take this, select the standard deduction, you don't have to prove anything. That's a given. That's why when you get a return, a refund from the state, you don't need to, that's not a taxable refund. Because we didn't reduce it by an amount more than the standard deduction. When you itemize your deductions, and you get a refund from the state, right? So right now we're talking about our federal return. We're talking about preparing the 1040 and the Schedule A. That's our federal return, but you also have to pay state and local income tax. So when you itemize your deductions, one of the things that you could deduct is the tax that you pay to the state and local government. If you then get money back, then you have to report that as income. That's a source of income. So if you itemize your deductions and you took $10,000 as what you paid to the state, to New York State and New York City, but then you got a refund, so that deduction is actually going to reduce our adjusted gross income and ultimately our taxable income. By what? $10,000. Just for that one amount that we paid for the state and local tax. $10,000. That's what we paid. And that's what we put on Schedule A. But then we got a refund. The refund was $5,000. So the IRS says, well, then the next year you should report that. Maria mentioned to us that one of the sources of income is taxable refunds, because you reduced your taxable income more than what you actually paid. So you paid $10,000 and you reported that. That was correct. You did everything right. I'm not saying you did anything shady. You did everything right. You reported the $10,000. But then after the smoke cleared, so to speak, and you filed your return with the state, you find out that you actually overpaid and you're entitled to a refund. So they send you back $5,000. But you already told the IRS, you already told the federal government that you had paid $10,000. And at the time, that was correct. You did pay $10,000. And it's even on your W-2. So you have proof of your withholding. Let's say you didn't have any estimated tax that you were paying in. It was just your withholding. And you paid, it says, $10,000 for your state and local tax on your W-2. But then, when you filed your state tax, it turns out that you had paid too much, that your employer had withheld too much from your weekly check, and you get a refund. You get back $5,000. So now, we need to report that the next year as income. Where do we report it? We report it as a taxable refund. That $5,000 that we got as a refund, we now have to report it as income on our federal return, on our 1040. Does that make sense? So, I think you'd be better off itemizing your deductions. If your deductions are more than the standard deduction. So, when you itemize though, if you get audited, you're going to have to prove everything. This is $6,200. We believe you. You don't need to show us anything. Whatever it is you paid on your mortgage interest, if it was $2,000 or $4,000, you don't need to show us that. Or your medical and dental expenses, if it was $1,000 or $2,000, it doesn't matter to them. They said, we're just going to give you that. That's $6,200. So again, when you itemize, and you get a refund from the state and local government, you need to report that as taxable income. If you take the standard deduction, you don't need to report that as taxable income, because that was just a given. That was a gimme. We didn't over-inflate our deductions. We only took the amount that they allowed. And they said, no questions asked, $6,200. Skip Schedule A. Go straight to $6,200. All right, so now that we determined our filing status, we realize that our deductions would be more than that. So we decided to go ahead and fill out Schedule A. Fun times! Anna, this is fun, right?
Sure.
Andrew, you can do it. Yes, you can. All right, so we're going to talk about Schedule A now. So we're going to itemize our deductions. Medical and dental expenses. Now, remember I was telling you about money that the insurance company paid? So the same thing applies as it relates to the first section of Schedule A, which is medical and dental expenses. So if your insurance company paid the bill, you can't deduct that. You could only deduct medical and dental expenses that you paid. If GHI or Blue Cross or Empire or whatever insurance you have paid, you can't deduct that here. Even you have a bill. I realize you have a bill from Kings County. You have an invoice. But the insurance company paid the bill. You can't deduct that here. So let's look at this example. So the first thing we're going to try and address is medical and dental expenses. Here we go. Our client, right, so we're the tax preparer. Our client was injured while jet skiing in Grenada.
Try Jamaica.
The next day she returned to New York and went to Kings County Hospital. So she went to the emergency room. They did some diagnostic tests, right? So she was injured. They weren't sure exactly the extent of her injuries. She had some diagnostic tests done, some x-rays, MRI. That was $4,000 for the emergency room. She went to see her primary care physician. That was $500. So she paid her primary care physician $500. She was referred to a physical therapist, and she got physical therapy 3 times a week for 3 months. That's basically a part-time job right there, right? 3 times a week for 3 months she went to physical therapy. And she paid the therapist $2,500. She was in pain, so the doctor gave her medication, and she paid the pharmacy $1,000. So she got some painkillers, probably Tylenol with codeine, or Oxycontin, and that cost her $1,000. Now, she submitted her bills to her insurance company, GHI, who reimbursed her for $2,000. So she paid all those bills, and her insurance company reimbursed her $2,000. So now the question is, for Schedule A, what is the amount of her qualifying medical and dental expenses? So let's see. What do we have here?
7,000.
Emergency room is how much?
4,000.
4,000. Physical therapy?
2,500.
2,500?
35.
2,500. Medication?
1,000.
And her primary care doctor?
500.
$500. So how much was the total amount that she paid? The total medical expenses that she paid?
8,000.
So she actually paid $8,000, but
She cannot deduct $8,000.
yeah, she can't. Giselle said she can't deduct $8,000. Why? Because so GHI reimbursed her $2,000. So the qualifying medical expense is $6,000. You can't put $8,000. But you say, but she paid. And guess what, Coach? This time I got the canceled checks, not just the invoices. I know, but the insurance company reimbursed her $2,000, so the amount that qualifies, her qualified medical expenses, are only $6,000. Which is what we're going to put on line 1 of Schedule A. So it says medical and dental expenses. Line 1, we put $6,000. But it can't be that simple, right? Nope.
Correct.
Not quite that simple. Not for us. Now last year, the amount, the percentage of the AGI that taxpayers were responsible for relating to medical and dental expenses was 7.5%. Now it's 10%, which means that 10% of AGI, the taxpayer pays the first 10% of AGI before they can deduct medical and dental expenses. So in other words, your medical and dental expenses, your qualifying medical and dental expenses need to be more than 10% of your AGI. So let's see how that works. So for line 2, now what is line 38? Line 38 is the back of the 1040, and that line, the first line on the back, is your AGI. So from the bottom line of the front side is the AGI. When you go over to the second side, what they do is they just make it at the top of the page of side 2. So it's your AGI. And so that's what line 38 is, because it says enter the amount from Form 1040, line 38. So what's on line 38? Everybody wants to know. What's that? Your AGI. $100,000.
Oh no.
That's what Genesis makes. $100,000 per year. All right? So on the Schedule A, line 2, put $100,000. That's the AGI. That $100,000 is the AGI. It was actually a lot more.
Yes, exactly what I'm saying.
Yeah, actually Genesis made a lot more money than that. But she had that rental property where she lost nearly $23,000. And then she had some capital losses from some stock trades. So actually her annual wages are $165,000. But her AGI is $100,000. So now what do we do with that? Well, on line 3 it tells us we need to multiply that amount, that AGI, by 10%. So 10% of her AGI is what? $10,000. So 10% of AGI is more than the $6,000 that she paid for her medical expenses. So the IRC, the Internal Revenue Code, says that the medical and dental expenses need to exceed 10% of AGI, but they didn't in this case. So line 4 says subtract line 3 from line 1. So when you subtract 10,000 from 6,000, you get 0. So the amount that you put on line 4 is 0. So on line 1 we have 6,000. On line 2 we have $100,000. On line 3 we have $10,000, which is the 10% of AGI, which is at $100,000. And then we subtract 10,000 from 6,000 gives us 0. So that trip to the Caribbean cost $6,000 in medical expenses, and none of that can be deducted off of your 1040. GHI paid $2,000, you paid $6,000. Next year you'll vacation in Brooklyn. Let's see. Now the next section is taxes you paid. So we're going to assume that the income tax, the state and local income tax that we paid, is $8,570. and there's no limitation. There's no 2%, 7.5%, 10%. It's the 85/70, whatever it is that we paid in state and local income tax, we can deduct. Now, for the house that we live in, the one that we're not renting, so remember I said we own two homes. One we rent, the other one we live in. We're paying real estate tax on that property. So this is where we would deduct the real estate tax that we're paying for that property. The real estate tax for the rental property is on Schedule E. For the property that we're not renting, we would report that on Schedule A. That's $12,430. We didn't pay any personal property tax, or we don't have any other taxes. So the total taxes we paid is how much? What are we going to put in line 9? So our state and local income tax is $85.70. Our real estate taxes we paid are $12,430. So Godwin says $21,000. So in line 9 we put $29,000. In line 4 we put 0, right? So in line 9 we put $21,000. That's the subtotal for the taxes you paid. Now the mortgage interest on the house that we live in, we could also deduct the interest that we paid. For the house that we live in, the mortgage interest that we paid on line 10 is $18,000. Questions about that? So on line 15, we're going to put $18,000. Gifts to charity, we didn't give any charitable donations, so that's 0. Line 19 is 0.
On this one, we're looking in the charity.
Yeah.
There's a limit for the charitable contribution.
Yep, says absolutely there's limitations. So all the money that Bill Gates gives, and people say, oh, he just takes it all as a deduction. No, actually, no. The amount that he gives, most of that he can't take as a deduction because it exceeds the Internal Revenue Code guidelines. So 0, and the casualty or theft losses, which has a 10% limitation, right? So, well, we're responsible for the first 10% of AGI, is, in this case, is 0. And the next section, job expenses and miscellaneous, is also 0, but importantly, note that in order for that to be deductible, it needs to be more than 2% of AGI. In this case, it's 0. So what is the total amount of our itemized deductions? $39,000. So that's what we put. That's what we put on the 1040. That's what we put on line 40 of the 1040. What is our itemized deductions? $39,000. So you can't take both, standard deduction or itemized, and or itemized. It's either or. So if you do standard, you can't do itemized. In this case, it makes a lot of sense, $39,000. So we're going to reduce our AGI by $39,000.
Well, AGI is 100,000, so.
And then we still have our exemptions. Questions? Best students ever? Aren't you guys amazing? Look at that, you did a Schedule E, a Schedule A. You guys are amazing! Anna!
Yeah, we're amazing.
Right, Zoya? Wasn't it fun? I told you it was going to be fun.
Oh, yeah.
Fun times. Come on, you could do it. Yes, you can.